I don't know if you've been watching the news lately and seeing all of these developments coming out of China. Companies like DeepSeek, who are challenging the future of AI by beating ChatGPT's model for 1/10 of the price, or BYD, who has overtaken Tesla in how many cars they sold last year, or Xiaomi, who has sold more phones than Nokia and Google and seems likely to overtake Apple, not to mention companies like TikTok, Alibaba, Tencent, and probably the biggest story for me as an investor is how China's stock market over the last year has beaten the S&P 500 and by quite a bit. So, as investors, are we sleeping on China? Should we be investing in some China ETFs? But also, what about the trade wars, the property crisis, banning of TikTok, and the risks of the government's regulatory crackdowns? Basically, should we be buying investments in China? Is it profitable? And what are the risks? But if we do, what funds and ETFs can we look at? That's what we're going to be talking about in today's video. So, let's get started. Over the past few years, China's stock market has been hit hard. The Evergrande crisis sent shockwaves through the real estate sector, wiping out billions in market value. On top of that, strict government regulations on tech giants like Alibaba and Tencent spooked investors, leading to a mass sell-off of Chinese stocks. But here's the thing. While everyone has been focusing on the bad news, Chinese stocks have quietly become some of the cheapest in the world. The MSCI China Index has been trading at historically low price-to-earnings ratios, which could mean an opportunity for long-term investors. But not only that, right here and right now, we are seeing the results of the last year, and China's large cap index of its top 50 companies has outperformed the S&P 500. So, in the last year, the S&P 500, the holy grail, grew by 21%, but in that same time, the China large cap grew more than double, with a growth of 45% in 1 year, and that is a diversified ETF. Now, this might come as a surprise considering all the negative headlines, but after years of underperformance, Chinese stocks have started to rebound, while US stocks, especially in tech, have become increasingly expensive. So, if you believe in value investing and buying when markets are down, China might be one of the best contrarian opportunities out there. Because even with that growth, we can look to the valuation. The MSCI China Index is trading at a significant discount compared to the S&P 500, and analysts are calling the China market cheap compared to its historical valuations. Because despite the challenges, China still remains the world's second largest economy, and its growth potential over the long term is hard to ignore. Because its market still houses some of the largest companies in the world. You have Alibaba. The e-commerce giant has faced regulatory crackdowns and slowing growth, but it's still a dominant player in one of the largest consumer markets in the world. Tencent, a leader in gaming, social media, and fintech. And by the way, Tencent is the largest reason why Naspers is the biggest company in South Africa, because they were an early investor. Then BYD, as the world's largest electric vehicle manufacturer and a company Warren Buffett has invested in, is at the forefront of the green energy revolution. These companies are not just Chinese champions, they're global players. And even though some companies aren't listed like DeepSeek and TikTok, these are companies that are currently influencing the world and the next industries. So why has China been so successful? Well, there are many papers and documentaries that go into China's success. I've watched quite a few of them, but I won't be able to do it justice. But some of the reasons are its huge population with over 1.4 billion people. It means that China is a powerhouse for labor and manufacturing. It also means any Chinese company has a huge base to sell to, make profits, and scale before going global. Also, for many decades now, China has been at the forefront of technology, data, and robotics, and as we all know, that is where the future has been going. There are many reasons, but in the last 50 years, China has been the biggest and fastest growing economy in the world, and some analysts predict it will overtake the USA as the largest economy in the next 10 years or sooner. And that's one of the reasons the USA has been fighting it so hard with sanctions and banning of their companies. And speaking about that, while all of this sounds amazing, we also can't talk about China without talking about the risks. You only need to zoom out to a 5-year graph to see that China's index has shown a 20% loss over the last 5 years compared to the S&P 500's 80% gain. So, let's chat about the risks a bit, and then I'll tell you about whether I will be looking to invest myself and what some of the best China ETFs are. But before we get there, on this channel for the last 3 years, I have been documenting my investing journey and showing you how I have grown my 6-figure investment portfolio with a 5-figure passive income. I can't show every investment in these videos, but if you want to see exactly what I'm investing in live and in real time on the day, along with monthly portfolio updates showing my gains and losses, my dividend income for that month, and my total profits, losses, and passive income, then you're welcome to come and join us in the Casual Cash Club on Patreon. I did an exercise recently and found that if you purchase the same amount in each company we posted about in the last 2 years, your portfolio would be in a 63% profit. I'm not saying that's always the case, but if you want to follow my portfolio and perhaps get some ideas for your own, check the link in the description, and I'll also put a 7-day free trial. So if you want to join our other 142 members, then we'll see you there. Now, China has been in the news over the last 5 years. The first, which we all try to forget, is COVID, and that did play a part for a time, but it's not really the main reason. The main thing that changed was the government in Beijing began to crack down on regulation. Essentially, they introduced restrictions and regulations on industries like technology, property, banking, and private education. Then, as a result of that, we hit the Evergrande crisis. You may have heard about it, but stricter regulations on borrowing affected the country's biggest property developers like Evergrande and Country Garden and sparked a property crisis, which in some ways was similar to the housing crisis of 2008. And then we come to the last part, which is the ongoing trade war with the USA. This has been a tit-for-tat game for the last 10 years, and recently with Trump as president, he has implemented an overall 10% tariff on goods from China with the potential for more to come. But while those exist, China is strengthening trade ties with Europe, Southeast Asia, and Africa and its BRICS allies. So, let's break it down. Risks on China essentially come down to 2 governments, the USA and China itself, as it increases its own regulations on companies. Because in many ways, China is surprisingly still a developing economy. The recent property crisis and regulations were a result of exponential growth and needing to put in additional guardrails. So, where does that leave us as investors, and what are our options? Well, first of all, let's be clear. This has been and still is a risky investment. It's not something I would recommend for beginner investors or anyone with a low risk tolerance. But I've been looking recently at ways to diversify my portfolio from the USA and include investments in other areas. And I think China is one that I want to use as a small portion of my portfolio, and partially just to see where it goes, to dollar cost average and hold over the long term, because I do enjoy investing in something after a deep drop, and I think it has long-term potential, but expecting that it may be money that I lose as well. So, if you do want to invest in China, I would personally stick to the major indexes, and the 2 that I've come across that are available on most platforms around the world are the iShares China Large Cap, which is the top 50 companies in China, or the iShares MSCI China ETF, which includes over 500 large and mid-sized companies in China. So historically, the MSCI China has performed better, mainly because of the regulations crackdown on larger companies, but over the last 5 years, they are around the same. Then in the last year, the large cap has outperformed the MSCI and currently has a lower price to earnings ratio. So personally, I have taken a look through all the literature of the 2 ETFs, and I have decided to invest £50 or 1,200 Rand for now in the iShares China Large Cap ETF. So while we're here, let's go and invest in it in real time. So I'll go into my Trading 212 app, And remember, these are also available on Easy Equities as well. And I'm going to invest £50 in the iShares China Large Cap ETF. So now it's part of my portfolio, and like I said, I'm going to keep it a small holding for now, dollar cost average over time, and we'll see how it does. But remember, I'm just showing my journey, but be sure to do your own research and make your own investments based on your financial goals and your risk profile. But guys, that is it for today's video. If you want to see more videos like this or how my investment does, then please like the video and subscribe to the channel. Be sure to join us on the Casual Cash Club to see all of my investments and portfolio updates live and in real time. And I will see you next time, as always, on Casual Cash. Cheers.